We all know that in retirement, or as you approach retirement, you should be taking less risk with your investments. Well, does that mean you should get out of the stock market completely in retirement? I've got that perspective coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So as you approach retirement, or maybe you're in retirement, does that mean you should take less risk, and therefore you should get completely out of the stock market? The big idea is, listen, you don't have as much time to recover from a big drop. We know big drops happen in the stock market. That's just part of the investing experience. There's no way to completely, perfectly avoid those. And so when they happen, well, they eventually will recover. And in retirement, the big idea is, well, I don't have as much time. So therefore, the question is, should you get completely out of the stock market? I mean, first you've got to consider your time horizon, okay? If I've got an investment, okay, that someone invested in it here, and they're not looking at it for 5 years, and that thing has bounced up and down and so on and up here, I mean, that investor who hasn't looked at it in 5 years probably pretty pleased with that. But if someone bought it at a high point and is looking at a low point, they must think, it's a terrible investment. But if someone bought it at a low point and looks at a high point, they're going to say, oh my goodness, this is the best investment since sliced bread. It's the same investment, it's just different time horizon, right? So a different time horizon can absolutely warp your sense of, well, is this a good investment or a bad investment? It might be a perfectly fine investment. Your time horizon was just off. So what is your time horizon? When do you need this money? One of the big mistakes that retirees make is, well, my time horizon ends at retirement. I'm going to need to start drawing some of this money. Therefore, none of it should be invested for the long term. It's all short-term money at that point. I would argue that's a mistake. You've got to look at your overall comprehensive financial plan, but you ultimately need to consider, what's my time horizon with this money, okay? That then drives how much of it should be invested for the long term versus invested for the short term. The second part is connected to time horizon, is quantifying how much of those retirement investments you actually need and when you need them, right? That's the time horizon part, but this next part is the math, okay? If in retirement, say you've got a small pension, you've got Social Security A, Social Security B, for husband and wife, and then you're looking and saying, okay, we probably need to draw $2,000, or we need to draw something out of our investments. Well, you need to quantify how much do you need to draw. Make sure you're considering taxes as well. Figure out how much do you need to be taking out of your investments to supplement your other income. Once you've done that math, once you've quantified the need, you can then determine, all right, how much of my retirement portfolio is really for the short term? How much will I need in the next 3 years? Okay, those dollars should be structured in low risk, short term. I mean, those are short term dollars. You shouldn't be taking long term risk, high risk with short term dollars. So how much? Once you've quantified how much you need, that's the money that you'd need for the short term and be invested for the short term. All right, once you've quantified that, you can determine how much you'll need for the midterm, the medium term. So years 4 through 10, or 4 through 8, or 4 through 9, depending on your situation, your life expectancy, and so on. All right, that's the money we'll need in the intermediate term. It should be invested that way. All right, and then everything else is there for the long term and should be invested for the long term. Most people make the mistake that at retirement, I'm going to start needing to access this money, therefore I've reached my time horizon. And that's not true. Kevin Korhorn often illustrates right there in the conference room on his conference room table, okay, you've saved up, and you've saved up this much, okay? Well, at retirement, you actually lay it on its side and you start spending through it over time. Therefore, this final chunk of dollars over here, this is still long-term money. You might be retiring at 65, but this is the money you're going to touch at years 85 to 90. right? How would you structure an investment? How would you structure dollars that you're not going to touch for 20 years? That's long term. The big idea with all of this is as you are approaching retirement or at the beginning of retirement, your investment philosophy, your investment approach gets more complicated. It's different getting down the mountain than it was climbing the mountain, okay? And you've got to look that time horizon and when you need the money is even a more crucial variable. Got to do the math. Working on a 5-factor retirement plan, you've got to do the math to say, how much money do I need and when do I need it? And that will help you determine what we call the personal pension plan. How much of this money do I need in the first 3 years? That should be structured in the short term. How much money will I need in the short term or in the medium term? That should be structured kind of balanced in for income. The income from that portfolio helps to replenish and replace the dollars that are being spent from that short-term bucket, okay? And then everything else, everything that you don't need in the short term or the medium term is over here in the long term. And the objective for those long-term dollars are to fight inflation and longevity risk, right? So they're growth, it's growth oriented, and because it's long-term, if those investments go down, you don't need to panic. You don't need to panic because you've got 3 years worth of short-term dollars, and another 3 to 5 years worth of income-producing dollars that are structured for the medium term. So you don't need to panic when your long-term dollars, even in retirement, drop in value. Hopefully you're still managing risk there and you can sleep at night and have peace with your finances. So it's not just take as much speculative risk as possible. It's just to be long-term and invest for the long term, okay? But then as those markets, as those investments recover or as they surge, you can look at taking some of the growth off of that long-term bucket, using it to replenish your medium-term bucket or replenish your short-term bucket. That entire structure, that entire choreography there, that's the personal pension plan that your certified financial planner should be helping you with as part of your 5-factor retirement plan. If that's the investment advice and the overall financial wisdom that you're getting from your CFP, that's wonderful. You're on track. If that's not the investment advice and comprehensive financial plan, financial wisdom that you're receiving, you can always contact one of the CFPs on my team. Find us online at korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well. Get all of our contact info there as well. Or you can just send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.